Today, light at the end of the tunnel or an approaching train. The Property Imperative Weekly is the 12th of October 2019. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering property and finance news with a distinctively Australian flavour. Thanks for joining me on my latest weekly digest of events over the past few days. A week in which a trade war ceasefire might just be emerging, the Fed denies it's doing QE, while locally confidence takes a hit even as mortgage lending is up a bit, and the calls for our own version of QE are mistakenly, in my view, getting louder. But be careful what you wish for. The two darkest clouds this year have been trade and Brexit, and both got a burst of sunshine later in the week. As normal, we'll start with the international context, which is appropriate given the fact that our economy is caught on the crossfire international trade, but if you want to jump directly to the Australian section, the time is shown below, and as usual, I have included a list of topics we'll cover today with times in the comments below. In New York, US stocks rose sharply on Friday as a Phase 1 trade agreement appears to have taken shape, although the details will not be bolted down for some time. The trade deal won't be as comprehensive as Trump had demanded, but it would include China buying more US agricultural products, somewhere around $40 to $50 million worth, and new additional tariffs which were to be imposed on $250 billion of Chinese imports next week won't happen following the talks between President Donald Trump and Chinese Vice Premier Liu. The sentiment in the market shifted from gloom to hope this week on the substantial deal, although it's not yet been put in writing according to Trump, and it may take up to 5 weeks to get the deal written, and he warned it may still yet fall apart. There was evidently some agreement on foreign exchange transparency, but nothing about intellectual property, which means that in a nutshell, there's not much meat to this agreement. But what Phase 1 means is that Trump gets validation from the markets and China gets their October tariffs delayed. And the next 5 weeks is really critical because this is the fourth time that the US has offered relief to China and trade relations soured quickly after. And there are also questions about whether the tariffs in December will be pushed off as well. China has extended an invitation for US officials for further talks next month. As the negotiations continue, investors will be watching the headlines closely to see if the trade truce stays. But for the time being, the Phase 1 deal eliminates near-term risks for China. As a result, stocks finished at their highest levels in about 2 weeks. The rally was very broad and saw the Dow Jones Industrial climb more than 517 points before profit-taking set in and cut the gain to about 320 points, closing at 26,814, up 1.03% on the day. The S&P 500 finished up 1.09%, but failed for the 16th day to close above 3,000, settling at 2,970. And the Nasdaq Composite climbed about 1.34%, closing above 8,000 for the first time since September the 26th, at 8,057. Shares in Apple hit a new intraday high of $237.63 as Webbush raised its price target, citing confidence in the company's new video streaming service. Its market capitalization is now at $1.06 trillion, which is close to Microsoft's $1.07 trillion, and Apple closed up 2.66% to 236.21. The S&P 500 Bank Index jumped on expectations that strength in mortgage banking and cheap valuations could provide support to some of the biggest US lenders. It closed 2.41% higher at 455.67. And Goldman Sachs rose 2.41% to 204.68. Bets for another interest rate cut by the Federal Reserve fell after data showed a rise in consumer sentiment for the month of October. The volatility index fell 11.48% to 1558 as risk concerns receded, at least for now. Interest rates rose as investors sold bonds to move to riskier assets. The 10-year Treasury yield moved up 4.71% to 1.734, while the 3-month fell a tad to 1.687, though still in inversion territory. And the Federal Reserve said on Friday that it will start buying about $60 billion per month in Treasury bills to ensure, quote, ample reserves in the banking system. But they emphasised that the new programme does not mark a change in monetary policy and it is not to be called QE. This is precisely not what the markets have been wanting to hear, in that there has been huge position taking further down the yield curve in the expectation that the Fed would use QE to drive interest rates lower, so bond prices higher, and bondholders would make a killing. The primary dealers, the 24 US and foreign broker dealers and banks authorised to deal directly with the US Treasury and the New York Fed, have been hoarding Treasury securities with longer maturities, with recent data from the New York Fed showing that they hold $161 billion worth, double the $81 billion a year ago, although down from a peak in July of $219 billion. Much of these purchases are funded from the repo markets. And this is purely gambling by the markets on the prospect of big returns if longer term rates go lower still. In fact, they have fallen, but many were holding out for deeper drops ahead. The Fed said these purchases would begin on October the 15th and are in response to recent disruptions in short-term money markets that pushed the target federal funds rate to the top of its target range and at least once above it. The technical program, which Fed Chair Jerome Powell signaled earlier this week, was on its way, will continue at least until the second quarter of 2020. And the US Central Bank began offering daily repo operations in mid-September after the repo rate, which is viewed as a measure of liquidity, spiked to 10% from about 2.25%. The daily operations are meant to ensure that there are ample reserves available during spikes in demand, and they will also continue to inject cash into overnight lending markets until January by offering daily operations in the market for repurchase agreements, the repos. And the Fed said its balance sheet expansion is meant to wean money markets off the daily operations by bringing reserves to a level that accommodates economic growth, but is also enough to absorb any spikes in demand. The amounts involved will be tuned along the way as the Fed learns more about how much liquidity is needed in the banking system, and the Fed will initially aim to bring reserves to about $1.5 trillion, the level seen in early September before a liquidity crunch led to a spike in short-term rates. But some strategists say the right level of reserves is between $1.6 trillion and $1.8 trillion. The new purchases of short-term bills are simply meant to keep money markets operating smoothly, and the Fed claims it is not another round of QE when they bought bond buys to push down longer-term interest rates to spur borrowing and investment. Thus, the Fed says that their new moves will therefore have little, if any, meaningful effect on household and business spending decisions and the overall level of economic activity, repeating that explanation no less than 3 times for emphasis in a statement that they released on Friday. Now, Treasury bills are securities with maturities of 1 year or less, such as a 3-month T-bill. They do not have a coupon. Instead, they're purchased at a discount from face value and are redeemed at face value. The difference is the yield for the investor. And here is the thing. Dealers have not been hoarding T-bills. As of October the 2nd, they were holding less than $7 billion in T-bills at the very low end of their 3-year range. It could be the markets have been outmaneuvered by the Fed as it contains its balance sheet growth, or it could be traders will try to engineer another liquidity run to force the Fed to purchase out along the curve and do more QE. If they're successful, then they profit from those longer-term bonds. If not, then they're going to lose out big time. Meanwhile, the US dollar index, which measures the greenback strength against a basket of 6 major currencies, was down 0.4% to 98.472. Elsewhere, oil prices moved more than 2% higher, in part because of the progress of the trade talks, which would be a boon to global growth, and prices also moved up on reports of an attack on an Iranian oil tanker. The WTI ended at 54.88, up 2.48% on the day. And gold slipped below the $1,500 an ounce closing at 1,493.40 and down 0.5% on the day, but still up 18.7% from a year ago. Bitcoin fell 2.73% on Friday to 8,340.7 and is down more than 20% over the past month. All three of the commodity currencies traded higher last week. Canada earns the title of the strongest economy. Friday's labour market numbers were exceptionally robust, with more than 53,000 jobs created in September, a figure that was 7 times more than expected. Full-time jobs increased 70,000, the strongest in 5 months and the second best reading this year, and the unemployment rate also dropped to 5.5% from 5.7%. Unlike many other central banks, Canada did not lower interest rates this year, and they have no need to after Friday's report. Elsewhere, the UK may be closer to a Brexit deal, and a nearly 2% rally in sterling reflects the market's optimism that an agreement can indeed be reached by October the 31st. The pound US dollar ended at 1.2649, up 1.68%, and on an intraday basis, the pound saw its strongest one-day move in more than a decade, following positive language out of Brussels, despite a meaningful decline in Britain's industrial and manufacturing production in August. It seems that the EU may have put an idea on the table different enough to allow negotiations to proceed. The EU's Michael Barnier described his talks with Brexit Secretary Steve Barclay as constructive because Britain has accepted that any solution to replace the backstop cannot involve a customs border on the island of Ireland. However, one viable option would be to do the customs checks in the Irish Sea. The EU wants to avoid a no-Brexit deal, and with less than 3 weeks to go, the intense negotiations in the days ahead could finally break the gridlock. And Boris Johnson and the Irish Premier said in a joint statement that they saw a pathway to a possible Brexit deal. The 10-year gilt yield rose 12.7 points as the pound jumped to a 2-week high against the US dollar, but how exactly the leaders plan to solve the Irish customs puzzle remains blurry. Boris Johnson proposed limiting custom checks away from the Northern Irish border, while Ireland responded that any customs checks inside Ireland would threaten the Irish peace agreement. Dismissing custom inspections in Ireland would mean that goods could be smuggled from the UK to the EU and vice versa, and one possible solution to avoid that would be leaving Northern Ireland out of the UK's customs zone, but this would see a solid resistance from many policymakers, especially from Democratic Unionists. This deal is not done yet, but the pivotal moment of a meeting between the British and Irish leaders was enough to convince strategists at Deutsche Bank to terminate a recommendation to sell sterling. The FTSE closed at 7,247, up 0.84%, and the FTSE Financials was up 2.31% to 728.35, and the Royal Bank of Scotland rose 11.46% to 218.30. Even the beleaguered Metro Bank rose 2.74% to 217.80. Risk appetite also helped the euro to climb to its strongest level in 3 weeks, to 1.1037, up 0.3%. The account of the last ECB meeting revealed how far apart Eurozone policymakers are on stimulus. Some members wanted a deeper cut, whilst others didn't feel that lower rates were needed. This division raises the bar on further easing and suggests that not everyone in the ECB believes that the region's outlook is as grim. Indeed, a number of bankers published a memo this week accusing the ECB of not keeping to its mandate, with QE and low rates taken too far for too long. See our post, is low-rate monetary policy about to implode? The Hang Seng advanced 2.16% as the trade optimism between the US and China brushed aside concerns about the Hong Kong protests ahead of the weekend, and gains in Shanghai's composite remained timid. It ended up at 2,973.66, up 0.88%, with the US dollar yuan closed at 7.0880, down 2.73%. Hi, excuse the interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, Please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. Locally, Australian banks are having their toughest time attracting investors, according to a new analysis by Copley Fund Research, which monitors flows in funds with $1.2 trillion under management. Copley CFO Stephen Holden said an exodus by fund managers has left 91% of the 430 funds in Copley's global analysis with zero exposure to the sector. That's the lowest take-up on record. On average, allocations to the industry are equivalent to just 0.05% of global funds. Regulatory concerns, faltering housing markets, and a low interest rate environment have prompted global investors to be all but throwing in the towel on their Australian bank investments. Opportunities elsewhere in the Asia-Pacific region are proving much more attractive, such as Singapore and India. Australia's major banks continue to be hit with additional remediation charges stemming from the Hayne Royal Commission. NAB announced $1.2 billion in additional charges that will hit its bottom line in the second half, in combination with provisions raised in the second half of 2018 and the first half of 2019, which have not yet been utilised. NAB's total reserve for customer remediation at the 30th of September was an astonishing $2.09 billion. And ANZ has become the latest major bank to announce additional remedial charges, taking a $559 million hit to its cash profits in the second half. In a research note published this week, Morningstar analyst Nathan Zaya suggested that there were bigger issues at play for ANZ. While remediation charges are disappointing and represent real destruction of shareholder capital, investors should be more focused on the bank's ability to stop the recent decline in mortgage growth, he said. APRA data shows ANZ's loan balances declined 0.4% and 0.2% respectively in July and August, lagging system growth by 0.2% per month. And meanwhile, global fund managers have been pressing the major banks and other Aussie corporates on executive pay on non-financial risks, two issues that have been thrown into the spotlight in recent months. In its 2019 annual stewardship report, NAD's largest institutional shareholder, Vanguard, said it warned the bank's former CEO and chairman as early as 2017 about a raft of problems within the organisation that eventually led to their resignation. We discussed remuneration charges that the company was considering and further explained that we'd voted against its plan because we felt it overemphasised short-term performance, the report noted. And last week, Morgan Stanley told investors that it has a negative stance on the major banks given a challenging operating environment, an uncertain regulatory environment, the growing threat of disruption and stretched trading multiples. While tail risks in relation to the economy, the mortgage market and the regulatory environment has decreased, we believe the combination of modest loan growth, the impact of lower rates, a multi-year reinvestment burden and changes to capital management prospects is likely to see the banks remaining in an EPS and ROE downgrade cycle, analysts at the investment bank said. And the economic news continues negative. For example, UBS highlights that there is a correlation between easing construction activity and construction job adverts and points out that this could lead to a material drop in construction sector jobs ahead. And UBS also said that inflation will be lower, suggesting that based on their proprietary survey, the Q3 headline CPI forecast is at 0.4% quarter over quarter, slowing from the second quarter's bounce of 0.6%, which was driven by a rise in petrol. This is partly due to a retracement of fuel down 2.3%, while their Evidence Lab grocery tracker has food up 0.7%. The year-on-year should hold at about 1.6%, they said, under the RBA's 2 to 3% target in 18 of 20 quarters. and is also tracking a tick below their 1.7% forecast for the end of 2019. Indeed, since 2014, inflation has undershot the RBA's 2.5% midpoint by at least 500 basis points, and a return to the path would require CPI to double its recent trend and rise by 3.25% year on year for the next, wait for it, decade. Globally, inflation remains relatively modest. Domestically, despite ongoing strong jobs, unemployment trended up, while stalling wages remain far too low for a sustainable rise in inflation. An upside risk is the fall in the Aussie dollar, but weak nominal retail sales still suggest limited pass-through. Indeed, business selling prices retraced and a range of inflation expectations slid to a near record low. So a trimmed mean forecast of just 0.4% quarter on quarter, unchanged from 0.4% in quarter two, and the year on year rate would tick down to an equally low record of 1.5%, partially dragged by a seasonally adjusted drop in electricity prices amid regulatory changes. This marks a record-long 15 quarters below the RBA's 2 to 3% target and 21 quarters below the midpoint, and again a tick below the RBA's 1.6% forecast. Indeed, after a per capita recession since the third quarter 2018, a disappointing consumer recovery means that the RBA's November statement on monetary policy will revise down their bullish 3% plus GDP profile. Well, certainly consumer and business sentiment were both down again. As we reported in our post, household financial confidence is crushed some more. And the Westpac Melbourne Institute Index on Consumer Sentiment fell 5.5% to 92.8 in October from 98.2 in September. This is the lowest level of the index since July 2015. And the index has fallen by 8.4% since the Reserve Bank started cutting rates in June and is down by 8.6% over the last year. The fall comes despite a further 25 basis point cash rate cut from the RBA at its October meeting, and that's the third rate cut since June, taking the cash rate to a new historical low of 0.75%. The result will be of some concern to the monetary authorities. Typically, an interest rate cut boosts confidence, particularly around consumers' expectations for and their assessment of their own finances. In this survey, these components of the index fell by 3.7 and 4.9% respectively. This may be because despite the rate cut, assessments for the economy overall plunged by 6% the 12-month outlook and 9.1% the 5-year outlook. Consumers, they say, are looking beyond the reason for the rate cut and arguably the absolute level of rates and are getting nervous. And business was as bad, with the NAB business survey showing further declines in retail manufacturing and construction. The point is consumers are unable to spend and businesses unable to invest. This is the dark truth in the economy. And high iron ore prices or more government infrastructure investment won't save the day. Turning to the property market, the latest auction stats from last week, which was a holiday weekend, are down, with a final clearance of 67.6%, according to CoreLogic, on 1,324 auctions, compared with 1,817 a year earlier. Sydney was at 74.7% and Melbourne at 70.5%, so we should be cautious again about claims the market is roaring back. And CoreLogic reported rises in Sydney and Melbourne home prices again, but again we should be cautious because these averages may be distorted by low volumes and a bias from the smaller number of very expensive properties selling at the moment. So the CoreLogic index to the 10th of October 2019 reported that in Sydney, prices rose 0.35% over the last week. They've risen 4.6% over the quarter. They've fallen 4% annually, and from peak they're down 11.5%. In Melbourne, prices rose 0.39% over the last week. They've risen 3.95% over the quarter. They've fallen 3.2% over the last year, and from peak they're down 7.5%. In Brisbane, prices are up 0.22% over the last week, up 0.9% over the quarter, down 1.7% over the last year, and from peak down 1.7%. Adelaide fell 0.08% over the last week, have fallen 0.68% over the quarter, are down 1.1% over the last year and are down 1.7% from peak. And in Perth, prices fell a further 0.19% over the last week, are down 1.86% over the quarter, are down 8.8% over the last year, and have fallen 21.3% from peak. And over the major five, prices rose 0.27% over the last week. They're up 2.77% over the quarter. They're down 3.9% over the last year. And from peak, they've fallen 8.4%. And the annual movements based on the CoreLogic series shows the continued rise in Sydney and in Melbourne, a very slight rise in Brisbane, an even slighter rise in Adelaide, and a continued fall in Perth. But the 5-city index, of course, is higher because of the movements in Sydney and Melbourne. And as we discussed in our post yesterday, total listing volumes are significantly down, and this may well suggest that in fact the market is easing rather than accelerating. And you can see our post, Spring has not sprung this year, for more details. We think prices are still moving down in many areas, including in the unit sector, thanks to the construction defects issue and the lack of appetite for investors, and in the outer suburban areas. Indeed, the ABC published an interesting profile on the outer western Melbourne suburb of Tarneit, one of Melbourne's fastest growing fringe suburbs, which is fast morphing, they say, into a modern migrant slum nightmare, with a lack of infrastructure and extended commute times. The area registers high on our mortgage stress analysis, and home prices are definitely under pressure there. And the New Daily reported that the company that built Sydney's Opal Tower is embroiled in another safety scare at a different city apartment block. Residents of Otto Rosebery have been warned against leaning on their balconies or allowing more than 3 people to stand on them after an investigation found the balustrades were of inadequate strength. Parents have been warned not to let children play on balconies, and now owners have flagged the possibility of pursuing the builder and developer in the Supreme Court. The 4-year-old building, comprising 298 units, is built by Icon Co. That's the same builders behind the now infamous Opal Tower, where major cracks led to an evacuation on Christmas Eve last year. In an urgent safety letter, residents were told the owner's corporation had received expert advice the balustrade system was structurally defective. A subsequent note from Strata Management said all possible precautions should be taken to avoid purposeful or accidental leaning, and warning notices have been plastered on balcony doors. The revelation comes after a series of high-profile defect scares and evacuations that have shone a spotlight on poor workmanship and lack of oversight within Australia's building industry, with problems reported nationwide. In July, residents of Melbourne's Australia 108 building reported significant movement and large cracking sounds in what is set to become Australia's second tallest building. In the same month, it was revealed that more than 100 homeowners were told they could not move into their newly constructed units in Erskineville in Sydney's inner southwest amid concerns the block was built on contaminated ground. And weeks prior to that, hundreds of people were evacuated and left homeless after cracks appeared in the facade of the Mascot Towers, also in Sydney. The repair bill there is expected to be more than $20 million and counting, and residents are against the wall and have renewed their pleas to the New South Wales government for financial assistance. Residents are being forced to consider 2 options to fund urgent remediation work at the 132-unit complex, but fear they won't be able to afford either. At an annual general meeting later this month, apartment owners will be given the option to proceed with a multi-million-dollar special levy or rescind it in favour of a commercial strata loan to fix the building. One loan proposal would offer up to $20 million at a 7.7% variable interest rate per annum over 15 years, with funds to be put towards stages 1 and 3 of the remediation works, which are already started. But one resident who did not want to be named said the options presented to us as owners are like choosing a preferred execution method. And another owner said both options are very bad, adding he'd spoken with a bankruptcy lawyer on Wednesday morning. We don't know whether the $20 million is the end or just the beginning. We have not yet received the final costing, the owner said. The Strata Committee can liquidate me if they push through the motion in the AGM. Now, of course, the Deakin University report in June found that high-rise defects were commonplace. In July, a class action was launched by Opal Tower owners who are seeking millions of dollars in compensation, and documents lodged with the New South Wales Supreme Court suggest the owners were suing the New South Wales Government and Sydney Olympic Park Authority, the owner of the land on which the Opal Tower sits. But last week, the Australian Financial Review reported that Icon and Opal's developer Ecove had also been drawn into the case. And more on 40 buildings, the ABC reported that an audit had revealed 30 South Australian buildings required urgent remedial work to deal with potential flammable aluminium cladding. But the state government is refusing to identify which ones are at risk. Security and safety are always one of the primary reasons that we do not want to reveal the exact locations of buildings with significant cladding issues, in line with other states, they said. One of the private buildings, identified as high risk, is currently still under construction. According to state government briefing documents, the 28 privately owned buildings are primarily multi-storey residential apartment buildings, but 2 publicly owned buildings have also been identified as high risk, and a further 21 privately owned buildings have been assessed as high risk, meaning remedial work should be carried out in the next 12 months. The buildings have been identified in a statewide review, which was launched in mid-2017 in the wake of London's Grenfell Tower fire, which killed 72 people, and tenants could be forced to cover some of the costs of remediation after the state government ruled out following Victoria, which invested hundreds of millions of taxpayer dollars to reduce the fire risk. The state government audit interim report has determined 7 privately owned buildings are at extreme risk and require immediate action and remedial work. The remedial actions would include removing aluminium composite panels from around exits, firefighting equipment and balconies, and in some circumstances removing the cladding from the first 3 metres above ground. And as I discussed in the US, we know that there are a number of bondholders in Australia who have taken positions on the assumption that the Reserve Bank will apply QE, and as a result yields will fall and therefore the price of bonds will rise. So there is significant pressure now from certain quarters to force the Reserve Bank into QE. And by the way, Philip Lowe this week published a couple of reports in his role at the BIS advocating QE as a successful strategy. I'm afraid that I am completely unconvinced by this. And the fact of the matter is we are being bounced into QE simply because the financial markets are demanding it. That is not, in my view, an acceptable outcome. And the latest credit stats were a little more buoyant, but only marginally so, and we discussed that in our post. And so briefly to the markets. The ASX was up 0.95% on Friday to 5,475.50. The ASX financials closed at 6,271.70, at 1.07%, and the local volatility index was down 5.75% to 1438 in expectations of the trade deal outcomes. All the main banks rose despite clear pressure on dividends. The Aussie dollar was up 0.48% to 67.89, while the Euro Aussie was down 0.11% to 1.6264. The Aussie Gold Cross was down 0.8% to 2,173, and the Aussie Bitcoin Cross was down 3.9% to 12,300. And so in closing, the markets reacted rather well to the trade news, despite there being much more to do. Ditto Brexit, but locally the leading indicators in the economy are weakening still, and we doubt the property sector will save us. We'll be updating our scenarios for our next live stream on Tuesday the 15th of October 2019 at 8 p.m. Sydney time. Here is a link if you want to mark your diary. And you can join the live chat and ask me a question there, or send one beforehand via the DFA blog. The links are in the comments below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.